The world of modern banking is one of the most complex systems human beings ever created. But how and why did it actually evolve like that? Today we will answer your question. History of banking takes us back to 15th century Florence and a powerful family named Medici. At the time international trade was picking up, colonialism had started, and money was a necessity. But everyone had different currencies, different coins with different weight, and that was slowing things down a lot. Solving the problem created one of the most powerful families in the history of Europe. Medici bankers profited by exchanging money between merchants who traveled all over Europe, and as you can imagine, Medicis traveled with them, making the first banking empire. Whilst banking in Italy was interesting, the birth of modern banking happened in London. At the start of the 17th century, people who stored gold in England, aka goldsmiths, started to realize something very interesting. Not everyone withdraws gold at the same time. This was a game changer. They could lend out gold that they didn't have and profit from interest. This practice is what we call today fractional reserve banking. And although it may seem like a fraud, it is how every modern bank functions today. This is where this story gets really interesting. Fractional reserve banking means that banks do not keep all the money deposited. They keep traditionally 10% of it deposited, and the rest is lent out or invested. Let's explain. If you deposit $1,000 in a bank, and a bank gives $900 to somebody else, and that someone deposits it into another bank, and that bank lends out $810, and so on. You get the point. Banks have the power to create money out of thin air. They pay you a small interest on your deposits, let's say 2%, and they charge you 7% when you take a loan. Their profit is the difference between 2% and 7%, and that is called net interest margin. Of course, in 2026, banks do all kinds of things to make money, and that is usually the issue everyone is concerned with. If banks tend to take more risk, the whole economy could crumble. All that invisible money and debt that is used to finance homes, companies, roads, and factories crumbles down, and the whole economy goes down with it. People lose jobs, inflation eats everybody's money, and real chaos sets in. 2008 financial crisis happened in US on Wall Street, and brought almost half the world down with it. Greece and Iceland were unstable for years due to consequences. So we now know that we need someone to control bankers so they don't get too greedy and destroy everyone's lives. Now we get to central banks. Think of central banks as the capo di tutti capi of banking. They bank commercial banks, the government, and the financial system as a whole. They are basically a backbone of the economy. Central banks control monetary policy, they control the money supply, interest rates, and the economic system as a whole. Every country in the world has a central bank in one way or another. US has the Federal Reserves, Eurozone has the European Central Bank, Japan has Bank of Japan, and so on and so on. These institutions are more powerful than most of the governments of the world and often are not controlled by government officials at all. Central banks have three main goals: controlling inflation, preventing banking crisis, making sure commercial and investment bankers are not too greedy, and they maintain economic stability. Well, it's safe to say that they haven't always been that successful at their goals, but nevertheless, they are very, very important. I know that all of this can be very overwhelming, but the most important thing that you need to understand about central banks is that they control this fragile and risky system that is allowing us to prosper. Creating money out of thin air is not a simple task and carries a lot of risk and responsibility, but it basically works like this. Commercial banks create money through loans, but the pipeline is controlled by central banks. They create money by buying government bonds, and that way they inject money into the economy so that banks get more cash and the interest rates fall so people will loan more money from banks. Now let's get back to something you will have an everyday interaction with for the rest of your life, probably. Commercial bank is a private or a publicly traded financial institution whose business is taking deposits and making loans for profit. Unlike a central bank, a commercial bank does business directly with individuals, households, companies, corporations, or small businesses. Commercial bank is where you go when you need some funding. It can be a new car, a new house, or a business loan to fund a new product line. So, as we covered earlier, commercial banks make money mainly through fractional reserve banking, which we explained earlier, and through payment services such as wire payments, ACH payments, checks, and card networks. The most important job that commercial bankers focus on is risk assessment. If banks lend out money to an individual who can't pay it back and doesn't have collateral to default on, a bank can survive. However, if they make the same mistake across thousands of people, not only can banks crumble, they could have a devastating impact on the economy and make life worse for everyone. So banks focus on something called the 5 C's of credit: character, capacity, capital, collateral, and conditions. Character. This is an assessment of the borrower's reputation and willingness to repay. Lenders look at credit history, payment track record, how long accounts have been open, and any past defaults or bankruptcies. For business loans, they also consider the management team's experience and integrity. The underlying question is, has this person or business honored their obligations in the past? Capacity. This examines the borrower's ability to repay from current income and cash flow. For individuals, lenders look at income, employment stability, and the debt-to-income ratio. What share of monthly income is already committed to existing debt? For businesses, they analyze operating cash flow, revenue trends, and profit margins. This is often considered the most important of the 5 C's, because even a well-intentioned borrower can't repay what they genuinely can't afford. Capital. This refers to the borrower's own money at stake: savings, investments, or equity contributed to a project. A borrower putting significant personal capital into a venture signals commitment and reduces the bank's exposure. For a mortgage, this is the down payment. For a business loan, it's the owner's equity in the enterprise. More capital from the borrower means less risk for the lender. Collateral. This is the assets pledged as security against the loan. If the borrower defaults, the lender can seize and sell the collateral to recover the debt. Common examples include real estate, vehicles, equipment, or inventory. Collateral gives the bank a second way out if the borrower's cash flow fails. Loans backed by strong collateral typically carry lower interest rates because the lender's downside is protected. Conditions. This looks at the broader context of the loan, both the purpose of the borrowing and the macroeconomic environment. Lenders consider what the money will be used for, the state of the industry the borrower operates in, economic conditions, and interest rate trends. A loan to expand a thriving business in a growing sector is viewed very differently from the same loan amount during a recession in a declining industry. Well, as you can imagine, this is category you as a borrower have the least amount of influence over. So the question is, what does influence interest rate trends? If you guessed it right. The capo di tutti capi: central banks. Central banks use commercial banks to funnel monetary policy mainly through interest rates. If a central bank wants the economy to cool down and fight inflation, so that banks will lend out less money, or if they want to stimulate the economy, they lower down the interest rate so that credit will be cheaper. Through this pipeline, they manage inflation and the money supply all at once. Commercial banks are used as transmission belt of a central bank when they want to regulate monetary policy. As you have probably noticed, we love to use the term capo di tutti capi when describing central banks. Maybe it is because our scriptwriters have seen too many mafia movies, but normal people also use terms such as lender of last resort or banker to the banks. What do these terms mean? If a commercial bank faces a liquidity crisis, more withdrawals than it can meet, it can borrow from the central bank. This is the discount window. It exists to prevent solvent banks from failing simply due to short-term cash shortages and to stop panic from spreading. Walter Bagehot's 19th century principle still holds: lend freely at a penalty rate against good collateral. Thus, lender of last resort. Just as you hold an account at a commercial banks hold reserve accounts at the central bank. When banks settle payments with each other, they do so by transferring these central bank reserves. It's the ultimate settlement layer of the financial system. We now get to the guys who truly make what you would call the big bucks. Investment bankers essentially make money by connecting those who need money and those that are willing to give it. They are a pipeline for big deals, and they move billions of dollars every day. They earn money by charging fees for their financial and legal services. They are often advisors of CEOs, and every time the CEOs of big companies make a large move, they go to an investment bank. They mainly make money through underwriting fees, mergers and acquisitions, and IPOs. If this is too much economic lingo for you, don't worry, we will explain everything. When a company wants to raise money by issuing stocks or bonds, it doesn't go directly to thousands of investors itself. It hires an investment bank to underwrite the offering. An investment bank buys the issues and then sells it to institutional investors and pockets the spread between. A pipeline between those who need it and those who are willing to pay for it. When a company wants to buy another company or merge with it, investment bankers are the ones who broker the deal and advise on it all the way through. This is the bread and butter of investment bankers because they do not put up their own capital, they only charge advisory fees, which are typically a percent of the deal involved, which can be up to a few $100 million if the deal is big enough. And now our favorite, IPOs. If a privately owned company wants to get to the big leagues, they typically need more capital for that kind of venture. They get that money from millions of investors on Wall Street, hence initial public offering. And who arranges the whole thing? You guessed it right. Investment banks. Investment banks are mainly checked and controlled by the IRS and the SEC, but when a big problem happens, central banks have to step in. Central banks have had a habit to bail out investment banks when they get into a problem so they don't collapse the economy. Thus, the phrase, too big to fail. If you want to learn more about banking or any other subject, subscribe to Conceptual Knowledge and goodbye.